real estate professional status. And let's talk about what that is and why that's so very important. It's like the golden ticket in our industry.
Welcome back, investor, to another episode of the Passive Income Adventures. We have Erik Oliver with us today, a depreciation and cost segregation expert. And this is going to affect you greatly because depreciation is where it's at, where the tax benefits of real estate are concerned. So thanks for coming with us, Erik, today.
Yeah, no, thank you for having me. And I'm glad to be here.
Yeah, where are you calling in from?
Salt Lake City, Utah.
Salt Lake City, Utah. That's our home base. We're going to be back there for about a year. My kids are tired of hiking and RVing, and they're like, can we move back to our house? The only house we have that we can live in.
Oh,
So
nice.
Salt
Yeah,
Lake.
Salt Lake is
So,
beautiful. Salt Lake is beautiful.
yeah, we lived there about, I want to say 5 years. And now we lived in Texas for 20 years. We're in Salt Lake for 5 years. We've been in Texas now again for 5 months. And they're like, how did we do this?
Yeah.
We back to the dry weather, the bugs and the fleas and all that. Yeah, we're excited. I think it's a really beautiful area. And I do love spending time outside. And it definitely is better for that than Texas for sure.
Oh, yeah. Dry heat, less bugs, like you said. We have 4 seasons here. Great place for outdoor activities for sure.
Yeah, you need winter to kill all those bugs. Okay, so the purpose of the show really, for those of you who are new or first time listeners, my name is Emma Powell. We basically retired early on our passive income and we like to go on adventures. And people started asking us a lot of questions about it. And we wanted to create a space where people could tell their stories about how they were able to pay for the adventures, the passive income adventures, and how they found the time to do it too. Because passive income is not just about money, it's also about time. And so we have people on the show who will educate us on how to more efficiently run a business that you can detach yourself from it someday, how to passively invest in things like real estate, and how to enjoy the tax benefits because any kind of return that you're getting can be made better if you are getting a little extra in there from the tax savings. So Erik's going to walk us through that process of depreciation today. And it's one of the most powerful tools we have in real estate specifically because it's the only asset that you can depreciate that's actually going up in value in real, which is what sets it apart from depreciating like your construction truck or something. So appreciate you coming in and teaching us. So Erik, tell us a little bit about your background, like where you came from, how you got into this, and the pivot points you had along the way, because you're in an industry that's not exactly mainstream. Most people hear about real estate and they think it's like this strange voodoo thing. And I think they're too scared to believe that it can build wealth. I know people who have done it, but they're too afraid, like maybe not me, because I've also heard of people who lost money. But the tax benefits really are what set this apart. So walk us through your background, how you got into this, and catch us up to the present day.
Yeah. So great question. Like I said, I was born and raised in Salt Lake, went to school here, got a degree in accounting. Wasn't intentional. It was just at the time I'm trying to get through school as quickly as possible. Math always came a little bit easier than the sciences and English, for example. So I'm like, hey, how do I get out of the school as quickly as possible? So it was either finance or accounting, ended up getting an
Okay.
accounting degree. Didn't really want to be an accountant once I got out of school, realized that I didn't want to sit in front of a desk and crunch numbers all day. So I actually got into some business development stuff that took me out of Utah. I moved to Virginia for about 12 years doing sales, business development, that type of thing. And then from Virginia, I went to New York, Long Island, New York for about 6 years, helped my father-in-law run a landscape company up there. He was getting ready to retire. At the time, we thought that was our end all be all. We were going to take over the landscaping company that he had had for 30 years. Ended up not doing that. He decided he wanted to continue to work. And so we were ready for a change. Was looking to come back to Utah. I had some aging parents and I had kids by that time, wanted to get back to Utah and came across this cost segregation job. Had no idea what it was, had to watch YouTube videos on what it was before I interviewed. But I knew that it had to do with accounting and I knew that it had to do with business development or sales at the time. And so that's what brought me back to Utah. I've been with this company now 7 years, dabbled in real estate prior to working here. But once I started working here and working with clients on reducing their tax liability and helping them build their income, I realized that real estate, whether it's active or passive, can be a powerful tool in building that wealth. And been able to be involved in a few real estate projects myself now. That's one of the great benefits. We go to different conferences across the country and speak, and I learn a lot of great information, a lot of useful information on real estate, the benefits of owning real estate. And so that's what brought me here. Like I said, I've been doing this for about 7 years now. The company's been around just over 25 years. And really, we just partner with CPAs, tax preparers, and then building owners to help reduce tax liability so they can take that tax savings and reinvest it into new properties or pay down their debt or go on vacation, what have you. But that's the idea, and that's how I got to this point.
Yeah, it's so when you first went, you just were looking for a job. So you're trying to come back to home states. Kids can be near the grandparents. You can help take care of the grandparents. And you're just out there looking for a job. And you found this one, you did some YouTube research, and you go and you sit with them, and they're like, "What do you know about this?" You're like, "Nothing." How do you convince them that you get that job?
That's a great question. So at the time, it was an up and coming company. They were looking to expand into a different market. Actually, Arizona was the market. And so it was because it was a smaller company, we did not have a great training program at the time. So in all honesty, it took me probably now I'm not the fastest learner, I'll admit that, but it probably took me a year and a half to really truly understand cost segregation and real estate depreciation. So one disclaimer that I always put out there is I am not a CPA. I don't know everything about tax. Quite frankly, I don't know a lot about tax. I know a lot about depreciation. And depreciation is a very niche accounting specialty, and especially depreciation for real estate. So sometimes people call and ask me questions about earned business income or child tax credits. I'm like, listen, I have no idea. Put my
Yeah.
hand, say, call your CPA and then call me when you buy a property and I can help you pay less tax. But it is a unique principle where a lot of CPAs or tax preparers they just don't have the bandwidth to dive deep into depreciation. They know I look at your general tax preparer as a general practitioner. They know a little bit about a whole wide array of tax topics. There's thousands of pages of tax code. And where we specialize, we're like the brain surgeons in our industry where we just do this one specialty. And so because we just specialize in depreciation and real estate, I think I was able to learn, like I said, not very quickly. It did take me a year and a half to where I felt comfortable talking to CPAs and going out and presenting. But yeah, that's the journey how I got to where I am.
Yeah, there are a lot of tax strategies with real estate, and I think that for your average passive investor who's going to be investing, some of them don't really apply. Like, I'm going to buy a property in an opportunity zone might apply if they're passing that on. You've got the 1031 exchange, you have the real estate professional status if you're full time in it. You've got active versus passive or earned versus unearned. Rental income is considered unearned. So you have a lot of tax incentives in real estate. And I find that most of them are more like nail files. They're like taken a little bit off and used in conjunction. They can add up to something pretty powerful. But the thing that for me is the most powerful is the depreciation on the property and then combined with my real estate professional status so I can take full advantage of that depreciation. And I think a lot of real estate investors get into this thinking like, I'm gonna never pay taxes again. I'm President Trump. And I think that's a very unrealistic hope. And oftentimes investors will call me up thinking, my wife and I are W-2, we're getting killed on taxes, and I want to invest with you so that I don't have to pay any taxes. And I'm like, not actually how this works. And so can you explain to us, just define what depreciation is, and just as importantly, what it isn't, like what it doesn't do for people? I think it's like a magic wand or something.
No, that's a great question. So depreciation really is it's a non-cash expense. So when you own real estate, one of the benefits of owning real estate is the ability, the government basically says that building deteriorates over time. So I'll use the simplest form. Let's say I build a new residential rental. So a residential rental depreciates over 27 and a half years. Commercial buildings, if I built a retail center, it would depreciate over 39 years. But the idea is if we go back to the residential rental, if I build a new residential rental, and I'm going to make the numbers real easy just because the math worked. But let's say I build it for $275,000 and it's a 27 and a half year asset. I get essentially a $10,000 write off every year for the next 27 and a half years. I take that 275,000, divide it by 27 and a half. That gives me a $10,000 depreciation expense for the next 27 and a half years. And that expense comes off of my taxable income. Now, it doesn't come off of my W-2 income. It comes off of, in for most people, what we call passive income. So I'll give you a couple scenarios to talk about passive versus active income. So I'll give you a real life scenario. I am a employee of Cost Segregation Authority, and I have a W-2 income, and my wife is in the school system. She works at the school district, so she has a W-2 income. We have investment properties that we have on the side. If I do cost segregation on one of my long-term rentals, that depreciation cannot be used to offset my W-2 income. It can only be used to offset my passive income. So that's a passive deduction. I generated that deduction through a passive activity, something I do on the side. Therefore, I can only use it to offset passive income. So let's say I do a cost seg study, I create a $50,000 deduction. I have $50,000 of passive income, meaning from my rental activities. I can use this deduction to offset or wipe out that income. However, if let's say my properties don't make any money, they break even. So I have a $50,000 deduction from my cost seg study on my rental property, and I have no rental income, then I can't use this $50,000 to offset my W-2 income. So what ends up happening is this just sits in a bucket. And as I have passive income, I can then utilize it in future years. It carries forward indefinitely. Now, there are some limitations. You do have the ability to take some depreciation up until you make over $100,000, and then it fully phases out at 150 on your active income. So if I have passive deductions and I make less than $100,000 a year, I can use some of that. But there's typically limitations. And so one of the things that you mentioned was real estate professional status. And let's talk about what that is and why that's so very important. It's like the golden ticket in our industry. The reason for that is, let's say I'm a W-2 employee, but let's say instead of my wife working at the school district, she manages our real estate full time. So in the eyes of the IRS, we qualify as a real estate professional because I shouldn't say we, my wife qualifies as a real estate professional because one, she spends more than 750 hours a year doing real estate trade or business. It equals out to about 14 and a half hours a week. That's the first test. The second test is that she spends more than 51% of her working time doing real estate. So let's say my wife had a part-time job. She was working 10 hours a week, but she was doing 30 hours a week on real estate. We could still tell the IRS that we are real estate professionals or that my wife is, and we could take advantage of those benefits. Now, what those benefits are is when you do real estate for a living, when my wife does real estate for a living, all the deductions from our real estate. So when we get those that 1/27th, remember the $10,000 I mentioned, or if we do a cost seg study and we accelerate it, we get a bigger deduction. All that depreciation can be used or can be considered active deductions because my wife actively does real estate for a living. Therefore, because they're active deductions, they can be used to offset our active income. So even though I'm a W-2 employee, I'm not a real estate professional, but my wife is, we file a joint tax return, all of a sudden those deductions can be used to offset my W-2 income. And so that is why we see oftentimes where you've got a high W-2 earner, maybe I'm a doctor and my spouse is fortunate enough to stay home because I make $500,000 a year as a doctor. My spouse stays home. My spouse manages our real estate. My spouse spends more than 750 hours a year doing real estate. They spend more than 51% of their time doing real estate. Therefore, we as a couple qualify as real estate professionals. My wife qualifies, and I can use all the deductions from our real estate to offset my doctor's income. That's best case scenario. What oftentimes happens, or what can happen, is in the example of my wife and I, we have real estate, but we can't use those deductions to offset our income because we're not real estate professionals. My wife worked 40 hours a week at the school district. So even if she worked her 14 hours a week doing real estate, which would be unrealistic in the eyes of the IRS, she's not spending more than 51% of her time doing real estate. So there's a real fine balance that as you're getting into real estate, as you're building your portfolios, you want to get with a tax strategist. A tax strategist is very different than a tax preparer. Let me just point that
Mhm.
out. We have tax preparers in the lobby at Walmart who will process your paperwork, your tax returns, and it spits out a number. That's somebody who's just taking inputs, putting it into a system, it spits out an output. A tax strategist will get with you and say, okay, what is it that you and your spouse, in my case, me and my wife, are trying to accomplish? We want to retire when we're 50. Okay, what does that look like? And how do we get there the quickest? And oftentimes, I know a lot of people who it makes sense for me to say, "Hey, wife, why don't we look at you possibly not working in the school district because the tax benefits that we're going to get are going to equal or be greater than what your salary is in the school district." And so now my wife becomes a real estate professional. And so getting with a tax strategist who understands that can help you as you start investing in real estate to determine what type of deductions do you need? Can you, in fact, utilize these deductions? Because there are so many horror stories. I've heard
Yep.
them. Really, you've heard them. We talked about it before we jumped on today, where people get into real estate thinking, hey, I'm going to pay no tax because I'm a doctor. I'm going to give a $500,000 to somebody to go invest in an apartment building and I'm going to get a huge tax write off. You are going to get a huge tax write off. The problem is you can't use it against your W 2 income in some cases, in most cases. And so understanding how active versus passive income works is super important when getting into real estate because you got to know what type of income you're trying to offset and you got to know the tools to offset it. Now, not to get too far in the weeds, there are some workarounds, and I'll give you a real life example. As I mentioned before, I'm a W 2 employee. My wife's a W 2 employee. We had a tax problem at the end of 2022, and we were going to owe a lot of tax when we filed our taxes in 2023. There is something called the short term rental loophole. I hate to use the word loophole because it sounds like you're doing something nefarious, but it's in fact part of the tax code. The idea is when you invest in a short term rental, it gets treated different than your long term real estate. So as long as the average stay is less than 7 days, which for most Airbnb type properties, it always is. And as long as you self manage that, which I do manage the property, then those deductions on that property are considered active deductions, and those can be used to offset my active W 2 income. So at the end of 2022, I knew I was going to have to pay a pretty penny come March, April of the next year. So I went and bought a short term rental in November of 2022, put it into service, did a cost seg study on that property. The cost seg study created a $140,000 deduction, and I used that deduction to offset $140,000 of my W 2 income, me and my wife's W 2 income. So if you're in a 30% tax bracket on $140,000, that's about a $45, $50 tax saving. Now, my down payment on that rental property was $80,000. So I put down 80, but just in my tax savings alone, I got back $50,000 of tax savings. And now I've got a revenue generating property that I'm renting out on a short-term basis. And so there's a lot of ways that you can oftentimes there's ways where you can find a way to utilize those deductions, but you just want to make sure that you know what you're getting into in terms of your investment vehicles and that you can in fact use those deductions because a great big deduction for somebody who's a doctor who can't utilize it, it doesn't do any good. It just sits on the books and it slowly gets utilized over time. But yeah, that was a long answer to your question about what is depreciation and how can people utilize it, the differences between active and passive. And
No, I thought it was fantastic. You obviously have explained this to people before for a long time. This is one of those things that we do on every single one of our properties. And when I first heard about it, I first started learning about it, I'm like, oh, that's amazing. But over the years, I've gotten more out of touch with the details of it because it's one of those things. It's just like when you're investing passively, you find an operator who knows what they're doing and they deliver for you over, you keep reinvesting with them. Click, cost sake, because it's like something that I can delegate out to an expert, then they bring it back and they save me $1 zillion. So I'm actually excited to talk to you today because if we don't keep up on it, we start getting a little bit rusty. And I definitely feel rusty on it. And so it gives me more of the perspective of the listener to be able to ask some questions from you to explain, like, why is this important for the passive investor? So I will, I have the first question that I have is when people are talking about their reps, stat, like exactly what you're saying. Maybe one of them is a stay-at-home parent already, and they're like, "Oh, I can become rep status if I spend 750 hours a year working on my real estate business," but they don't own any properties. And I'm like, you can't have depreciation without properties. You can't just go become a real estate agent or mortgage lender or something like that and say you're a real estate professional, right? But that doesn't help you if you don't have the depreciation to go along with it. So that's my first question. How do you explain that to people who are misunderstanding that concept of how the depreciation actually helps them? The reps like boosts it, but it doesn't create depreciation out of nothing. I actually hear this question a lot. So
uh,
I know it's one of those, did you try turning it off and turning it back on type of answer? Walk us through that.
yeah, no, that's a great question. So yes, rep status just allows you to take the depreciation differently. But at the end of the day, rep status does not create depreciation. So depreciation comes in many forms. We're talking today about real estate. So as I mentioned, when you buy a property for 275,000, you get to take that non-cash expense, that depreciation of, in that case, $10,000 a year off of your income. But if you don't have now the rep status, what that does is it allows you to take it off different types of income. You can take it off active versus passive. But you've got to have the depreciation, which means you've got to have the real estate. So whether you're investing in properties on your own or you're investing passively, oftentimes when you invest passively, so let's say I'm a doctor, I've got $500,000 I want to invest. If I give that off to a syndicator to invest, they're going to go take my 500,000 and that person's 500,000 and that person's 500,000 and they're going to go buy a big apartment building. What ends up happening is that they will, because they bought that $30 million apartment building, they're going to have a whole lot of depreciation because now we're taking 30 million, dividing it by 27 and a half years. And essentially, I can't do that math in my head, but I know it's over $1 million a year that they have in depreciation. And so they get to offset income by $1 million. Now, what happens is that deduction gets distributed out through K1s to the individual investors. So I am an investor. I'm a doctor. I gave you 500,000. You went and bought a $30 million apartment building. In return, I get a K1 at the end of the year that says you've got this big of a loss. It's going to say that basically the apartment didn't make any money. Now, the apartment probably made money, but let's say the apartment made $800,000 of cash. I have $1 million deduction. It now shows that there's $200,000 of loss on that building. It's a non-cash loss. It's a good loss. We want to lose. We want that kind of loss because what that does is that 200,000 comes to me, the investor, or gets distributed out on the K1. And now I can use that to offset my income. If I'm a real estate professional or my spouse is, I may be able to use that to offset my W-2 income. Worst case scenario, I'm not a real estate professional. I can use that $200,000 of passive deduction. In that case, it would be passive to offset any other passive income. So maybe I have passive income from stocks, or maybe I've got other rental properties that turned an income. So maybe my other rental properties made $200,000 this year, but I've got this $200,000 loss from my apartment project that I'm invested in. I can use that deduction to offset this 200,000 of income. So yes, you do want rep status enhances, or we call it rep status, real estate professional status. It enhances the ability to utilize depreciation, but it itself does not create depreciation. You either have to have properties you've invested in, or you have to invest in other people's projects to be able to get those deductions. Once you get those deductions, the rep status dictate, I don't know if dictate is the right word, it influences how those deductions can be utilized. So hopefully that answers that.
Yes. And it's time for another dumb question.
No, you-
So if somebody is investing in real estate through a real estate investment trust, it's a publicly traded fund on the market, right? Do they get any depreciation from that real estate investment?
That's a great question. I don't deal a lot with REITs or real estate investment trust. I would think that if you're invested in that, you would own a part of that and you would get deductions. Now, those deductions would most likely be passive, would be my guess, but I check with your CPA. Don't quote me on that. Don't go put your life savings in a trust saying, Erik said I'm going to get a huge deduction, because I'm not 100% positive in that. But my guess is that, yes, it would be treated similar to a syndicated deal where you would get some deduction from the investment in there.
I feel like that there's a lot of arguments about private placement syndications versus REITs and the benefits of one versus the other. And I've never, a lot of people aren't even thinking about depreciation when they're investing in that type of thing. What I've found is that yes, some of them do, and no.
And some of them might not, because here's what I do know is that oftentimes they can dictate where that depreciation goes. So in their operating agreement, they can say, we're going to go buy a $30 million apartment, but the operator of that, I need that $30 million deduction, or it's not going to be a $30 million deduction. I need that depreciation. And so we're going to kick out dividends to you guys from the cash that's coming in from that, but I'm going to utilize the depreciation to offset my own income. So
Mhm.
there's types of investment vehicles, and you really got to be careful when you're reading the operating agreement because just because you and I both put in $500,000 into $1 million project doesn't necessarily mean that we're both going to just split the deductions evenly or the depreciation evenly. So it's a different, people are allowed to, you're allowed to allocate the depreciation expense however fit. Now, there are certain entity setups where it doesn't allow that. There's some entity setups where if you and I are 50-50, then we both get 50-50 of the depreciation. There's no way around it. But a lot of times with different syndication deals, the operator may decide, hey, I don't, or I've seen it the other way where I don't need any of the deduction. I'm the operator. I've got other investments that are kicking off deductions. I don't need any of the deductions. And so I'm going to give you even a bigger deduction. And so it just depends on what is the purpose of your investing. If you're investing, some people invest for the appreciation. Like I'm going to give you this 500,000 and I hope in 10 years that 500,000 turns into a million. I'm in it for the long haul. You've got other investors who are like, holy cow, I've got a tax problem this year. I'm going to give you this $500,000 to invest, but I need in return a 300 or a $400,000 deduction to offset my income. And so there's different reasons why people invest, and there's different vehicles and different syndications or different REITs that they can invest in that will accomplish different goals. And so just be wary, not wary, be aware
Yeah.
when you're investing what it is you're getting. Are you getting a tax break? Are you getting appreciation? Are you going to get a big payout in 10 years when they sell this property? What is it that you're investing in? And is it the right investment for you? Because maybe I'm a doctor and I have high W-2 income. I need some depreciation. I need my spouse to qualify as a real estate professional. I need some depreciation where other investors are like, hey, I just got all this money. I need to go park this money somewhere for the next 10 years till I retire. And they're looking at cash flow and appreciation. But just make sure you know what you're getting into when you're investing.
Yeah, we had that same experience when we left. Both of us no longer had a W-2, so like the opposite of what you're talking about. And so we didn't really have any earned income for the first, I don't know, I probably at least the first year, right? Really no earned income. And so we didn't need more depreciation.
Right.
What we earned basically was offset like 100%. And then we had extra. And so instead of carrying that forward, we basically traded it to one of our partners in each deal. I'm like, hey, does anybody want some more depreciation? And everybody's like, me. And then they traded us a portion of their cash flow. And we just wrote up a little contract and then gave over and had the accountant who was preparing the K1s take that into account, how much of that was allocated to each of us. So even though it wasn't in the operating agreement, what it was going to be, it was, but we were still able to retrade that afterwards. And I thought that was a really powerful tool for us as basically only passive income earners to be able to make use of other people's needs for more depreciation. Okay. I went to a presentation that you guys did in Salt Lake City a couple of years ago when bonus depreciation was being reduced from 100% to stepping it down. And somebody in the audience is like, what are you guys going to do when bonus depreciation goes away? You're all going to be out of a job. And the presenter was like, cost segregation has been around a really long time. It's not the same. Accelerated depreciation is not the same thing as bonus depreciation, which is not the same thing as just straight line depreciation. So those are things. What is the difference between depreciation, accelerated depreciation, and bonus depreciation?
Good question. That's a great question. And I apologize because I probably should have stated what cost segregation is a long time ago. So so let's talk
Okay.
about we're going to use the example of that single family rental that we bought for 275,000. So if I don't do cost segregation, I'm going to take what we call straight line depreciation, where I take that $275,000 building, divide it by 27 and a half years, and I'm going to get a $10,000 deduction every year for the next 27 and a half years. That answers one of your questions. That is called straight line depreciation. When you do a cost segregation study, you're accelerating the depreciation and you're taking those deductions at a faster rate. So instead of taking the depreciation evenly, getting 1/27th of a deduction for the next 27 years, I'm going to front load that and take a bigger deduction in the early years of ownership. So now, why would you do that? There's time value of money, there's inflation, there's a number of reasons why I want my deduction now versus spreading it out evenly over the next 27 and a half years. Dollar today is worth way more than a dollar 27 and a half years from now. So I want to save my taxes now versus then. The way we're able to do that is through an engineering-based study or a cost segregation study, where we identify different components of the building. So when you buy a home for 275,000, you're not just buying the land and the walls, you're also buying some appliances. You're buying some carpet, some LVP, you're buying some countertops, some cabinet. All those things I mentioned, the IRS says, "Hey, carpet doesn't last 27 and a half years. Carpet is actually a 5-year asset. Your countertops are a 5-year asset." The reason that most CPAs will just use straight line depreciation is because they don't have a technique or an ability to identify how much the carpet is worth of your $275,000 purchase price. So a cost seg study comes in and we, just as the name implies, we segregate the cost into different buckets. So now we say, okay, of that $275,000 purchase price, 60,000 of that was for 5-year assets. 70,000 of it was for 15-year assets. And what we get to do is we get to take that 60,000 of 5-year assets and we get to split that up over 5 years versus spreading it out over 27 and a half. And that's called accelerated depreciation. We're taking our deduction at a faster rate. So we've got our straight line, your even deduction over 27 and a half. We've got accelerated, which pushes things from what normally gets depreciated over 27 and a half. We take different parts of it and we put it into 5, 7, and 15-year bucket. It's usually about 30% that falls in those buckets, and then the remaining 70% stays in that long-term bucket. And then we have something that's called bonus depreciation, which basically takes cost segregation and puts it on steroids. And so I don't know if you guys remember back to, I don't even remember what year it was, the election
Your
when
job,
Trump, yeah, the
2017.
Jobs Act was
Mhm,
2018. But when
mhm.
Trump was running for president, they were in a debate and they were giving him a hard time for not paying taxes.
Yeah.
I was waiting for him to say cost segregation on the national stage. He didn't say it. Did say depreciation. He goes, "I have all this depreciation from my investments or my real estate that offsets all of my income, and that's why I pay very little tax." So back to bonus depreciation has been around. Like I said, it puts cost segregation on steroids because what it does with the Tax Cuts and Jobs Act, that was the bill that Trump passed as part of his tax overhaul at the end of 2017, 2018. But he basically allowed you to take 100% bonus depreciation on any asset that has a useful life of 20 years or less. So let's think about how that applies to real estate. Real estate normally gets depreciated over 27 and a half years or 39 years. So neither of those qualify for bonus because in order to take bonus, you have to have an asset that depreciates under 20 years. So if you're taking your straight line depreciation, you buy a building, we buy that single family rental for 275. I just have to take my straight line depreciation. I get 127, no bonus. If I cost segregate that asset and break it up into 5-year assets, 7-year assets, and 15-year assets, all of a sudden those three categories are less than 20 years, which means they qualify for bonus. So my 5-year assets, I think in that example, I said we found $60,000 worth of 5-year assets. Instead of splitting that up over 5 years, which would be great, that's better than straight line depreciation, splitting it up over 27 and a half. But instead of splitting that up over 5 years, I get to take 100% of that all in the first year. Now, 100% of my 7-year assets and 100% of my 15-year assets all in year one, which means I'm creating a huge deduction in year one. So bonus depreciation or 100% bonus was available for any assets placed into service between 9/27 of 17, so September 27th of 17 through December 31st of 2022. After that, any assets placed into service in 2023, they got 80% of the bonus depreciation. So remember in my example, I had $60,000 worth of 5-year assets. I would get 80% of that 60,000 as a write-off in year one. The other 20% gets spread out over the next 4 years, essentially. And so bonus depreciation in 2023 was 80%. Here in 2024, at the time of this recording, it's at 60%. And then it's going to slowly phase out until 2027 when it's down to zero. However, there is a bill in Congress right now to extend the 100% bonus through 2025. It's passed the House, sitting with the Senate. Unfortunately, we're in an election year. We have the presidential election here in November. I don't think anything is going to pass between now and November because they don't want that to look good for either party. And
Mhm.
so, unfortunately, what they're doing is they're just sitting on it. It has bipartisan support. I do think it will get extended to 100% bonus will get extended through 2025. However, I think those folks who bought properties in 2023 are going to be stuck at 80 because if and when this passes, it will be until after the presidential election in November, which will be past the extension deadline for the 2023 filings, meaning everyone will have already filed their 2023 taxes by the time they extend this 100% bonus. And so I don't think they're going to retro date it back to
Right.
2023. I do think they'll retro date it for 2024. So when we file our taxes next April, the hope is that they will have agreed on this tax bill. They will have extended it and we'll be able to take 100% bonus on any asset that we bought this year. But we'll have to wait and see. Like I said, it has bipartisan support. I think because we're in an election year, there's a few Republicans in the Senate that don't want this to pass because they don't want it to look good for Biden just before the elections. And so they're sitting on it. Regardless of who wins the election, I do think it'll get passed and then we'll retro date it and hopefully we'll extend the 100% bonus. But again, long-winded answer to your question, but that gives you an idea. You've got your straight line depreciation, 1/27th or 1/39th of a deduction, depending on the type of asset. You've got your accelerated depreciation with cost seg, where we push those deductions up into early years. And then you've got your bonus, where we take that cost seg and we amplify it by getting even a bigger deduction in the first year. Great way to reduce tax liability by using some of these benefits.
Yeah, and this is one thing that when I first started real estate investing, I would go to like our local club meeting and I would be sitting there and somebody would get up to talk about taxes or maybe insurance, but especially taxes. Over the years, I started getting more and more interested in what they were talking about because I've almost started looking at our tax savings as another stream of income for us. This kind of stuff, especially 100% bonus depreciation, changed our lives. And here's how. As a real estate professional, and married to a W 2 guy, right? We not only paid no taxes, he had his exemptions as high as they could possibly go, right? And we were still getting large 5-figure refund checks. So, what do you do at the end of a year when Uncle Sam gives you a 5-figure refund check? You go buy another rental house. So, we basically bought our retirement home before we needed it and we're renting it out. And that thing has doubled in value. At the same time, we were still living in our primary home. So just 1 year of tax refund along those lines basically allowed us to take a trajectory in our business that we never would have been able to do otherwise. And so these strategies can be very powerful. But like you said, you have to make sure you can actually use it because it is what it is until it isn't, right? This is
Right.
how it works until that's not how it works. So just
Right.
making sure you can actually use them, I think is really important. And I mentioned some people in my real estate club were talking about cost segregation, and he ordered the study and on his rental portfolio, and his CPA was like, "You can't take any of this because you're maxed out at 12.5 a year." You're going to get all of that depreciation eventually to carry forward, and so the cost seg study in your case was not a good use of your funds to go and do that on your little rental portfolio while you still have a W-2. So who is not a good candidate for a cost seg study? Because every single one of my commercial properties has it, but we've never done it on our small rental portfolio. And I don't know, maybe I should.
That's a good question. I'll start by saying anybody who owns real estate and has a tax liability should at least run some preliminary numbers. Now, that doesn't mean that you're going to be able to use those numbers. That's a question that we like to get at our firm here. We like to get the CPA involved to find out if you can, in fact, use them, but we need to know what those numbers are first. So if you own real estate and you pay taxes, you should at least have an analysis done. And then the conversation is between us and your CPA. We get on the phone and say, okay, we've got, even on your small single family rentals, we've got $200,000 of deductions available to us. One, does the client need these deductions this year? And two, can they in fact use them? And there's just so many variables that go into, do they need the deductions and can they use them? That really is a case by case scenario. For example, maybe I'm a W 2 employee. My wife is a W 2 employee, but we sold one of our rental properties and we have a $100,000 capital gain. That may be an opportunity to do a cost seg study because I can take the deductions from other properties, offset that capital gain, and pay no tax. So even though neither of us are real estate professionals, that may be the right year to utilize cost segregation. So I will say this, cost segregation is one of the few tools that I'm aware of in real estate that you can pick and choose when you use it. A lot of other expenses, like if I were to build a pool at one of my rental properties, I would have to recognize that expense the year I built the pool. Depreciation, you can pick and choose it. So if I don't have high income this year, or my wife isn't a real estate professional this year, but next year she's going to quit her school job and she's going to qualify, then I don't want to do cost seg this year. I just keep those projects in my pocket and I do cost seg in a future year. So the only time I tell people not to do cost segregation is if one, they're not paying any taxes. So they have enough deduction through other investment vehicles, or it's a low income year until they don't have any tax to pay. You don't want to do obviously cost seg then. But other than that, you should probably have the numbers ran. But again, you always want to. I hate to hear those horror stories where people pay for cost seg studies and then find out later they can't use them. It's very important. And again, that's why we like to get the CPA involved early to say, hey, here's an analysis. We do a quick benefit analysis. You send us your portfolio. We'll run some quick numbers and say, okay, based on this portfolio, conservatively, we know we can generate $200,000 of depreciation or whatever the number is. And then let's go talk to your tax preparer to see if you can in fact use it. And let's see if you in fact need it. And so then we decide, okay, you don't need 200,000. You only need to offset 80,000 of income. So let's just do 2 or 3 properties. Let's do all 10. And so that's a conversation that needs to be had again with your tax preparer.
Yeah, bringing them in really early because I've even heard CPAs when they get a cost seg study in, they think it's a scam. They've never even heard of it. So
Yeah.
make sure that the CPA meets you pretty early on because I did hear one story where they were trying to tell them not to use it. What do I do? What do I do? I said, get a new accountant.
Yeah.
Okay, one more question that you brought up, recapture, depreciation recapture, and how that affects people, because that might be a situation like if you plan on selling the property within a certain period of like it's more like a slow flip where you're going to keep it for a couple of years. How do we handle the depreciation recapture? Because I don't hear anybody talking about this. It's like the dirty little secret of depreciation where nobody wants to talk about how you have to recapture it when you exit a property. First of all, what is that? And second of all, how can we continue to kick the football down the field, so to speak, so we don't have to recognize or realize those recapture
Yeah.
penalties?
So so depreciation recapture, there's 2 types of tax you pay when you sell an asset. You pay capital gains tax and you pay depreciation recapture on the depreciation you've taken. So again, I've been sitting here saying front load, take bonus, take all this depreciation up front. And sometimes we'll get pushback from CPAs saying, let's just, it's just a timing issue. Because if I take all this depreciation up front, when I sell the property in 5 years, I have to pay it all back. That's not entirely true. So the idea behind cost segregation is when you do have to pay it back, you do have to pay some of it back, but you're paying it back at a lower rate on a lesser amount and saving the spread. I'll back into this example because I think it makes more sense. Let's say I buy a property for $1 million and I sell it 5 years later for 2 million. If I don't do cost segregation, I'm telling the IRS that everything is doubled in value, right? I bought this office building with all this stuff in it for 1 million. I'm selling this office building with all this stuff in it for 2 million, and they're going to charge me tax on that gain. My land has gone up in value. My walls have gone up in value, but my dirty, nasty carpet that's stained and is 5 years old, I shouldn't be selling that for more than I bought it for. When you don't do cost segregation, that's what ends up happening. You're paying gain on something that didn't go up in value. Carpet goes down in value. And if you remember from earlier, I said carpet is a 5-year asset. So what is the book value of my carpet when I sell my building after owning it for 5 years? Zero. Has zero value according to the books. It's fully depreciated. So when I say take your deduction today using cost seg and using accelerated depreciation and bonus, you take your deduction today against your ordinary income rate. So let's say I'm in a 37% tax bracket. I'm taking my deduction at 37%, paying some of it back, not all of it. The sum of it depends on how long you've held the asset. I'm paying some of it back at a recapture rate of 25% and saving the spread. So take your deduction today at a high rate, pay back a portion of it at a lower rate at a future date and save the spread. And that portion is dependent upon how long I own the asset. So back to your original question, we've seen scenarios where we've run numbers, and even if you're only going to hold it for 1 year, it still makes sense to do cost segregation because of that rate arbitrage. We're taking the deduction at a high rate. Let's say I take a $1 million deduction at 37% and I pay, so that's 370,000 of tax savings. And let's say I pay it back at, let's call it 25%. That difference is huge and should be realized, and you should take that. And so even when, like I said, even when there's a year where you're only holding it for a year, even though you're paying, I take a deductions at $1 million at 37%, even if I'm paying 900,000 of that back at 37%, that's still $100,000 difference, which means I saved $37,000 in taxes, even though I held the property just for 1 year. Now, that rate arbitrage game that I just described, it doesn't always make sense on small assets. So if I have an $80,000 single family home in downtown, I shouldn't do a cost seg study and then sell it the next year. I might save $1,500, but I'm going to have to pay $3,000 for the study, which means I didn't save any money. I actually lost money. And so those are analysis that a good cost segregation provider will walk you through those analyses and ask those questions and say, hey, what is your investment strategy? How long do you plan on holding it? Okay, you only plan on holding it for 2 years. Let's run some numbers and let's see what those numbers look like. What tax bracket are you in? How long are you going to own it? Because we can run projections to figure out what that savings would be, but you don't want to be caught in a situation where you pay $3,000 for a study or $10,000 for a study, depending on how big the building is, and your tax savings is less than that. And so again, that's why most reputable cost segregation companies out there are going to run that free analysis beforehand, because we don't ever want to engage somebody who's not going to save significant tax savings on the back.
Yeah, and this concept of what you're describing has saved us a couple of times from cost seg expert who told us, "Oh, don't do a cost seg on this building because you're going to sell it in a year and a half or whatever." But then I'm thinking of one example where we had a partner who wanted the cost seg anyway and fronted the cost for it because high income earner needed a high income real estate earner, right? Needed that and ended up saving us money in the end. And when originally they told us that it wouldn't be a savings. Another example I can think of is an RV park owner, and they didn't know that underground stuff that has a different depreciation schedule than above ground stuff. And so when they got their cost seg study back, it exceeded the an estimate because the person who done the estimate did it wrong, really. And so they saw that estimate and they're like, wait a second, I thought that RV park underground utilities, it depreciates faster, right? And so the fact that that team was keeping up on top of that, they were able to then go back to their cost seg estimate and be like, are you sure this is accurate? We had something similar. We're renting a marina land and they told us we couldn't depreciate anything that was built on the rented land. I'm like, but we own the stuff we built it, we own it, the buildings and all of the utilities we put in, and had to go back and say, hey, I don't think this is correct. And they reassigned us to a person. And so these kinds of situations where as an investor or as an owner, you have to stay somewhat up on it so that you can make sure that the person that you're delegating to is doing a good job. Because the engineer, or whoever actually comes out to look at it, I don't know, sometimes they just don't quite match up. So working with a team and making sure it's being done to the maximum benefit, it's been something I've really learned. We got to be aware of the details and we got to pay attention. So even the limited partner who might be like, oh, cost seg, cost schmeg, right? Like I am a W-2 and I earn more than 100 grand. I don't get to use any of this, right? Still just being aware of it and working with your CPA so that you can maximize your investing strategy. How are you gonna save money on the taxes? You might only be saving money on the rental income. That might be it for you. But just being able to be aware of how that works and what's applied and what's not applied, just keeping a finger on the details. You never have an excuse to take your foot off the gas.
No, agreed.
Yeah. Can you tell us a little bit about your own passive income, like your own passive income adventure journey? Because I talk to a lot of people in the space and they're coming to present to our real estate investing clubs. They're sitting across from me at a closing table, a mortgage lender, and they say things like, I watch this day in and day out. Real estate investors coming back year after year, getting richer and richer, or tax preparers, bookkeepers, people like that. And they're like, what am I doing? Why am I not in on this? And how do I get in on this? And sometimes they'll even ask me, like sitting at the closing table, hey, I think it's probably because I'm a woman. They feel like comfortable asking me, like, how do I get on this? I feel like I've been missing out on this for years. So how can you tell us about your future journey, how you've been impacted by what you're doing right now, and how that's changed your outlook on your own future and your own passive income journey.
Yeah, no, that's a great question. So I think understanding, and again, I didn't understand any of this stuff prior to working here and getting involved heavily in cost segregation, depreciation, real estate investing. But the whole idea for me and my journey is to, in that example I used with the short term rental, I was paying $80,000 to the government. So I was going to have to write a check. Actually, I had already paid some of that. I was going to have to write an additional check when I filed my taxes. And I'm thinking to myself, why am I paying this to the government when in their own tax code, it tells me that if I go buy a short term rental, I get this tax deduction. And so I use that 80,000 that I was normally going to pay the government, use that to put it down on a rental property. I got a big chunk of that back, 50, $60,000 of that back. And so I ended up saving, in my mind, $60,000 in taxes that I used to further my journey. So my whole goal is to use the tax code. It's interesting. I heard someone speak recently and they said, and I don't, I'm quoting them. I don't know the exact numbers, but the idea is that there's very few pages in the tax code that tell you what you have to pay tax on. Everything else in the tax code tells you how not to pay tax. And so understanding or building, I don't expect all of us to understand everything tax, right? We just don't have the bandwidth. But building a team of people who understand these concepts as you're investing can help you get to that goal quicker because you're using money that a lot of people, unfortunately, are paying to the government that they shouldn't be. And so understanding it, my goal is to accelerate my investment journeys to get more properties at a faster rate and pay less taxes so that I can eventually just retire on my passive income. A lot of us lose focus of that. We hear so much about how to get more properties, go buy this, go buy that, add more doors. But if you can, I've seen situations, especially in down where the market's downturn and people have had higher income years by not adding a single door to their investment portfolio. But what they did is they came up with a tax strategy. And so they saved all this money that was sitting there prior. And so I'll use a sports analogy. I come from a sports background where I played sports growing up and stuff. It doesn't matter if you score 120 points in a basketball game. If the other team scores 121, you still lose, right? And so we need to play defense with our money. And I look at tax strategy as playing defense with our money. Yes, you do need to go buy doors. You need to have real estate coming in and you want to increase the size of your portfolio. But equally as important is being able to protect or keep that money. It's not what you make, it's what you keep. And so being able to keep that money and having a comprehensive tax strategy is very important. So again, I hope to utilize the stuff that I've learned in this job and through the different conferences that I've been able to go to and participate in to accelerate or make this journey a lot quicker by utilizing some of these tax saving strategies that the IRS has given us access to.
Yeah. It's so smart. And I see so many people at the conferences, doctors, lawyers, IT guys, they're very almost overrepresented. And I'm like, where are all of the accountants? Where are all the mortgage brokers? Where are the commercial brokers? Like, why are they not here doing this stuff that they're surrounded by all day long and see like the wealth building? Sometimes people are just so busy hustling at their business that they don't really think about how am I ever going to get to the point where I am not hustling? Because we're high achievers. We don't ever want to retire, right? But we also
Right.
don't have to keep working. Like trust me, when I retire my passive income, I will find something to do to keep me busy. Do not worry. I don't lose my purpose and sit around. Yeah, no, we're not built that way. So what does that look like for you? Like you mentioned earlier, and maybe you're just saying it was as an example, like, oh, let's say I want to retire at 50. If you retired at 50, let's say you're able to pull all this together and you get your passive income rolling, you got your tax savings as an extra stream of income. What does retirement look like for you? Do you take a few months? Everybody takes a sabbatical, right? But then what?
Right. No, that's a good question. My goals, my wife and I's goals, actually, we love Hawaii. Our goal is to retire in Hawaii. And so part of my investment strategy, I would like to get a rental in Hawaii that we can use as a short-term rental until we do hit that point where we can retire. And then we would eventually retire in that home. As far as what I'm going to be actually doing, we want to be at a point where we can travel. So I want to be able to retire, but still have income coming in that allows us to travel. So that's been my passion. I would love to be able to see different parts of the world. We're only on this earth for so many years. And I know a lot of people who have never made it out of this state, let alone out of the country.
Mhm.
And so just on the few trips that I've taken out of the country, there is so much to the world that for a lot of us goes unseen. Different climates, different cultures, different foods, different all kinds of stuff. And so it's important for us that when we do retire, we want to be able to still have income that allows us to be able to go travel. And so that's my goal is to be able to one, retire in Hawaii, and then two, still have income to be able to travel so that we're able to see different parts of the world.
Yeah, and it's amazing how when people start living that lifestyle, how they allow that to kind of change them. My
Yeah,
partner's perfect example. They get out there, they start doing the thing, and they see a problem that needs solved, and they start a nonprofit and
sure.
start solving the problem. And so
Right.
it allows us that freedom of letting our best intentions match reality instead of just thinking, "Oh, I would do this if I could," but
Yeah.
bring that up. So that's a beautiful vision, and using a W-2 job, leveraging it the way that you have to be able to go and do what you're planning. I don't think that people give enough respect to the W-2 as a way to leverage, whether they're paying you money to do something, you can leverage that money to go invest, but also in your case, giving you knowledge that you can put into play and go do something really cool.
Yeah. I've been exposed to investment opportunities simply because of the job that I have. And networks of people. One thing that I would like to continue to do, even in retirement, call it, is to invest in properties and having a huge network of people like yourself who I've been able to meet in this industry, collaborate, look at different projects together, pool money together on things that we need to pull money together on. All that is because of the job that what's the word? Accidentally landed in. I mean, I didn't seek my kids joke. They're like, "Dad, did you say you wanted to be a cost seg provider when you graduated college?" I'm like, "No, I had no idea what cost seg was." But been a great opportunity for me. And that's a great point, Emma, that you said. If you do like real estate, find a job in the industry because I'm fortunate enough to speak at a bunch of different conferences. But when I'm speaking there, I usually spend a day or two there listening to all the other experts and all the other different principles and areas talk their talk. And so I've learned a lot about short term rentals. I've learned a lot about syndication, opportunity zones, 1031 exchanges, all this stuff I didn't have knowledge before. And so if it is something that you're interested in, find a job in the industry because you'll learn a lot. I've probably learned more from the investors that I work with, even the conferences that I've gone to, just hearing their stories and their investment strategies and what they're looking to accomplish. And so just surrounding yourself with those people is important.
Yeah, and we're definitely not brain surgeons. Like a lot of us don't really specialize in anything. We're more generalists. And so we
Yeah.
build teams around us. And that network that you're mentioning, not just the knowledge, but the network, that is really the point of the podcast, where we want people to reach out to us after the podcast, invest, do business with us, ask questions, get pointed. This networking is what makes this business go around. So we encourage everybody to reach out. You can get a hold of me at investwithemma.com. Erik, how can people get a hold of you after the show? And I always ask, more importantly, why should they get a hold of you after the show?
Yeah. So you can reach me on LinkedIn. I'm definitely on LinkedIn. And then also through our corporate website, it's just www.costsegadauthority.com. My contact information, email, phone number, that's all out there. Please use us as a resource, you guys. The why they should contact us is because nobody likes to overpay taxes.
Yeah.
And so it's not for everybody, but we should at least have the conversation. Like I said before, if you own real estate and you're paying taxes, let's have a conversation. Let's see if we can save you money. I tell people every day, no, cost segregation is not a good fit for you. We're very upfront. I don't ever want to charge somebody for a cost seg study. They're not going to get 7 or 10x return on the back end. But we've got to have the conversation. Let's run some numbers. Let's figure out where they are. If it makes sense with you and your CPA, then we move forward. If not, then we don't. So please reach out to us. Like I said, if you've got real estate and you're paying taxes, that's the reason why you should reach out to us because none of us want to overpay our taxes.
Yeah. And some of our limited partners, even they're like, when are you guys getting your cost seg study done? Because my CPA said I need that. Yeah. It empowers you to be able to make better decisions and talk to the operators and make sure that they're doing things that are in your best interest. Definitely reach out and go take the knowledge, just like what Erik did at his job, and go make something of it. This is a real thing. And you've seen it day in and day out with people making money. And you're like, I need to jump in on that. Really just Just don't discount this stuff because you're scared somebody else can do it or you might do it wrong or make mistakes. I was a stay-at-home mom, a homeschool mom. Like the most expensive thing I knew how to a service I knew how to provide was like taking people's photos or teaching piano lessons. So go take care of this stuff. I cannot urge you enough. Like this is life-changing information that we're sharing for free. Never pay for information. Grab the free call with Erik and educate yourself. So thank you so much for coming on the show. And when I'm back in Salt Lake in a couple of weeks, we should
Sure.
get together in person and talk some shop.
All right.
So
So thanks, Emma, for having me. It's been great.
all right, be sure to reach out, investwithemma.com, and tell me about the next passive income adventure that you have coming up. Until next time.